Hello, my name is Drew Williams. I'm from Rutherfords Real Estate. I thought our clients might be interested in some key points that I've picked up over the last 17 odd years in the industrial property sector, particularly related to industrial investment. I suppose I've dealt with Melbourne's most successful industrial investors, and there's some key things that stand out, some patterns that you pick up over time, and I just thought it would be worth going over some of those points. One of the things I notice with industrial investors is that they create their own sort of personality and they find their own niche within the industrial property sector, and this has got the benefit of creating a lot of focus. I think the most successful are the most focused on a particular location or property type or property age or something like that. I often see investors go out of their little niche area and then quickly return to it. I think long term they do a lot better with that clear focus. But I think there's probably 11 key areas that I'd like to cover, and I break them into two areas. Firstly, in particular, the property itself. We should always start with the property, and then secondly, the lease. The property itself, really, number one, of course, the age-old principle: location, location, location. So the proximity to the CBD, the proximity to the ports, the proximity to the airport, the proximity to freeways. These key points make such a difference long term to the investment as a whole. Then there's the type of asset. So at the moment we're just talking about industrial property investments. That's the part of the market that we're concentrating on. But within that, then there's a decision to be made about whether the property's an older property or whether it's a newer property, whether it's a smaller property or whether it's a larger property. So there's benefits, pros and cons for all of them. An older property, for example, generally the yield will be higher, so the return's higher, but then of course the maintenance is higher and it takes longer to release. Whereas a newer property, generally the yield's tighter, or it's a smaller yield on the return on investment, but then the maintenance is lower and it's much quicker to lease. Then you compare a larger property and a smaller property. So a larger property, generally the leases are longer, the tenants are more corporate. Generally there's a better yield on a larger property. On a smaller property, the yield is normally more compressed because you're competing with the mums and dads. You're competing with the smaller investors, 1, 2, 3 million. You're competing with a lot more people in smaller space. However, and of course the tenants are smaller, so generally the risk is higher, the businesses are newer, they're startups, etc. However, if one of these properties become vacant, the impact is a lot less than a large property. So the difference between 10 properties of $1 million that becoming vacant for a period of say 6 months, the impact is a lot less than say a $10 million property becoming vacant for 6 months. It's unlikely that 10 smaller properties all become vacant at the same time. So there's pros and cons with all of them, but it's important to consider when you're purchasing an investment property, all of these items: age and the size of the property, and the pros and cons of both. The next point is pretty simple, really. It's the height of the warehouse. We're talking about industrial properties here, and the difference between a building that was built 40 years ago and a building built today, one of the most significant differences is the height. So height determines the volume that can be stored, and that has a key impact on how long the property remains relevant and competitive in the market. The next one, which is closely related, it's really very similar, is the access. So the access in and around the property, the number of oladors, the hardstand yard, how wide the entrance is for the trucks, whether there's one-way flow, or whether the trucks have to turn around, whether the turnaround area is adequate. This is another key point that determines the difference between how quickly a building's released and how long it remains competitive in the market. We're seeing, you go back to properties closer into town in Brunswick and Preston, and what will strike you is that the properties are lower, they're built boundary to boundary, and the access is very poor, and it's impossible to get semis, not a chance getting B doubles in. and the larger trucks becoming more prominent. B-doubles are normal now, and there's talk of larger vehicles in the future. So height and access is really important, and then of course there's the longer term influences like development potential in the future. Is there two-street frontage? Has the building got a lot of frontage to the street, or is it a narrow frontage? What could it be developed into for higher use in the future? Then there's a much longer play again, which is the rezone potential. Is this property in an area that is surrounded by residential, that's got potential in the future to have a higher use? Perhaps townhouses, perhaps residential, perhaps bulky goods or showrooms. Then there's the lease. Now the lease is critical. There's several considerations with the lease. One of the first ones that I like to emphasise is consider the building as vacant. So when you're looking at the building, don't buy on return. Consider what's the value of the property vacant, what's the rental value, and what's the sale value. Don't buy a property based on an inflated rent. So if the rental is currently at market and the property would achieve the same number if the building was vacant as you are looking at paying for the property, then it's probably a good investment. But if you've got an inflated rent and you're buying it on a tight yield, if that tenant doesn't survive the term of the lease, or at the end of the lease you take it back to the market and you've got to release the property, your return on investment is very different. I see mistakes with this all the time. Consider the property as vacant, check the numbers before you proceed with a purchase. And then there's rental increases. So when you're comparing two investment properties, always look at the total rental received over the committed term of the lease. So if the lease has got 5 years to run plus options, then calculate out what the total rental to be received will be over that 5-year period, including rental increases, and then compare. If the rental increases are not fixed and they're CPI, then take a conservative estimate based on the last 3 years of CPIs. The rental increases have a big impact on your long-term return on investment. The next point to consider is guarantees. This is really important. I see a lot of investors getting into the market really not understanding this process. So the best form of guarantees is a security deposit, which is pretty much like cash. It's got to be held in a trust account, or a bank guarantee. Either or, and normally speaking 3 or 4 months as a minimum. Be wary of personal guarantees. I would hesitate to rely on a personal guarantee. Generally we find that the people that matter won't give personal guarantees. People that will willingly give you a personal guarantee, they've probably set it up so that it's not worth much. But bank guarantees or security deposits will be what funds you in the situation of a tenant defaulting on the property or doing damage to the property when they leave. So it covers make good, it covers vacancy period. It's a worst case scenario, but you certainly want to consider the guarantee when comparing investments. And then options. I think the key thing with options is to realise that it's at the tenant's option, not at the landlord's option. So if you see a property with a 5 + 5 + 5, so you've got a 5-year term, you have a 5-year term, you don't have a 15-year lease. The options are at the tenant's option, not the landlord's option. So really, with the other example, with a 5 + 5 + 5, the tenant's tied up the property for 15 years. The landlord has no idea whether they're going to be there for 5 years, 10 years or 15 years. So it's worth keeping that in mind, that options are in the favour of the tenant. I see a lot of investors getting into the market say, well, they've got a 5 + 5 + 5, they must intend to stay for 15 years. Not necessarily at all. They might be just giving themselves security that they've tied up the property for that period, and it's completely at their option. So keep that in mind as well. And then last but not least, the tenant. Critical that you check out the tenant. So check out the company, check out their trading history, check out the directors. You can do this with a Vita credit check. Very simple, cost-effective process, gives you a lot of information, very helpful. And then of course trade references, so I would suggest a minimum of 3, and speak to suppliers, ask them the size of the account per month with the company, ask them how quickly they pay, ask them if they've had any issues, ask a few penetrating questions, and that'll quickly paint you a picture as to what your experience will be with a tenant. So industrial investments really can be a very richly rewarding investment. The return on investment is much higher than most other property asset classes. The maintenance is normally far less, and the tenants pay the outgoings. So they're a fantastic investment. But all of these points need to be taken into consideration. Happy investing.